part 2, you need to discuss other considerations that should be taken into account when making the financing decision. Now, if you go back to the lecture where we covered the financing decision, I provided you with 8 different headings, and I told you that those headings should be used as a trigger for your discussion. Now, obviously, you can't force it. It must be applicable to the scenario. So if you can't discuss something under a certain heading, then you obviously ignore that heading. The whole purpose behind the headings is to just help you remember the various different things that should be considered. So let's go through each of those headings. First, we start with cost considerations. And the next heading is issue costs, which is transaction costs. So let's first discuss these 2 headings over here. If you go back to the required, you have been specifically asked to discuss other considerations. In part 1, we calculated the most cost-effective finance. We compared the loan to the preference shares, and we calculated that the loan is more cost-effective. In addition to that, we did take the transaction costs, which would be payable on the loan when they first entered into the loan agreement. We took that into account in our calculation. So we can't discuss cost considerations or issue costs over here because that has already been dealt with in part 1. We are now looking at other considerations. So there's nothing to discuss over here. That was dealt with in part 1. Then next you need to consider the impact of each financing option on cash flows. Let's first discuss the cash flows relating to the loan. When Bulletin enters into this loan agreement, they will commit to these cash flows. They will commit to paying these annual amounts over here and also the balloon payment at the end of year 4. And regardless of their financial performance, even if they have a bad year, even if they are experiencing cash shortages, they still have to meet these commitments over here. On the other hand, the preference shares offer a bit more flexibility because dividends do not need to be paid on preference shares in periods of cash shortages. However, it is important to note that we are dealing with cumulative dividends or preference shares that carry a cumulative dividend. So that means if a dividend is missed in 1 year, so let's say they have a bad year and they don't pay the preference dividend, that does need to be caught up in subsequent years because the preference shares carry a cumulative dividend. So the dividends that are missed will just accumulate until they are actually paid out. And it's important to note that preference dividends must be paid before ordinary dividends can be paid. So if Bulletin has a bad year and they skip one of these preference dividends, they're going to have to catch that up before they can pay dividends to ordinary shareholders. Then the next heading that we need to consider is matching or suitability. And what we are trying to do over here is match cash inflows with cash outflows. Or in other words, they need to make sure that the cash inflows are sufficient to cover cash outflows. So if we have a look at the loan first, we know what the cash outflows are for the loan. Annually, they have these payments that need to be made, and then at the end of year 4, they have a balloon payment. So if they want to go for the loan option because it's the most cost effective, they need to make sure that their annual cash inflows are sufficient to cover the annual cash outflows and also the balloon payment at the end of year 4. And for the preference shares, we follow the same logic. What is the annual cash flow for the preference shares? It's the dividend that's going to have to be paid on the preference shares. And if you perform the calculation over here, you'll see this is an annual dividend of 400,000 Rand. So obviously, if they want to go for the non-redeemable preference shares, they'll need to make sure that the annual cash inflows are sufficient to cover the preference dividend of 400,000 Rand every year. However, worst case scenario, if they don't have enough money, remember they don't have to pay this dividend. It will just accumulate and it will be caught up in future years, but it must be caught up before ordinary dividends are paid. However, with the loan, we know they don't have a choice. With the loan, they must meet these annual commitments and they must pay that balloon payment at the end of year 4. So with the loan, they really need to be careful and make sure that they have enough cash inflows to cover these cash outflows. It's also important to note with the preference shares, because they are not repaying capital, they are only paying dividends on the preference shares every year. The annual cash outflow is obviously a lot lower. So this is a lot safer. They only need to make sure that the cash inflows, or that they have cash inflows that are sufficient to cover cash outflows of 400,000 Rand each year. Whereas the loan has much larger commitments that need to be met. But obviously the advantage of the loan is after year 4, those cash flows then stop because the loan has been repaid. But with the non-redeemable preference shares, these are going to be preference shares in perpetuity. So this dividend over here is going to be paid in perpetuity or indefinitely. So they need to make sure that indefinitely they have enough cash inflows in order to settle this annual dividend payment over here. Then the next heading that you need to consider is associated constraints. And this applies to the loan. You were told that a significant portion of assets will be pledged as security for the loan, and debt to EBITDA must not exceed 0.5. So the loan has a significant portion of assets being pledged as security, and the problem with that is it will restrict the company's ability to borrow funds in the future. Because if they want to borrow funds in the future, they're also probably going to have to give assets as security, but they can't give those same assets as security. So that's what the problem is. Then in addition to that, we also have debt covenants that have been imposed by the bank. And the risk obviously with this is if they don't meet those debt covenants, if they don't maintain a debt to EBITDA ratio of 0.5, or if it exceeds, 0.5, then the loan becomes repayable. And if they can't repay that loan, the bank is going to repossess their assets because those assets have been given as security. All right, so those are the discussion points under associated constraints. Then the next heading that you need to consider is the risk profile of the company or capital structure. So let's discuss the loan first. The loan will obviously be classified as debt finance. So if Bulletin enters into the loan agreement, that's going to cause their gearing and financial risk to increase. Now, financial risk just means there's a risk that they will not be able to meet those loan commitments. So maybe they have a bad year and they don't have enough cash available to meet the loan commitments. Maybe interest rates increase so they can't meet those loan commitments. Whatever it is, by taking on more debt, they increase their gearing and financial risk. On the other hand, because the preference shares are non-redeemable, they are never going to be redeemed. They will be classified as equity. So by going for the preference shares instead of the loan, they will not increase their gearing. And that will allow them to borrow more in the future if they need to, because they are keeping their gearing levels low, which gives them capacity for debt finance in the future if necessary. Given the current economic environment and the fact that they are operating in a declining industry, the print media industry is declining, and they haven't actually yet developed their online platform, and we don't know if that's going to be successful. So taking all of that into account, even though the loan is slightly cheaper than the preference shares, it's probably still better for them to rather keep gearing and financial risk as low as possible and rather go for the preference shares. Then the next heading that you need to consider is control. Now, entering into a loan agreement or issuing non-redeemable preference shares is not going to have any impact on the control structure of the company. They are not issuing any ordinary shares. The preference shares are not going to convert into ordinary shares. They are just non-redeemable preference shares. So there's nothing under the heading of control that we need to discuss. And then the last heading that you need to consider is interest rates. We know that interest on the loan is linked to the prime lending rate. So that is going to expose Bulletin to interest rate risk. There's a risk that if interest rates increase, obviously that will cause this coupon rate to increase and the annual cash flows on the loan to increase. And that could have a negative impact on their financial position. So the loan will expose them to interest rate risk if it's not appropriately hedged. Obviously, the interest rate risk can be hedged by using interest rate swaps, etc. On the other hand, although this is not an interest rate, it's a dividend coupon, the preference shares have a fixed dividend coupon. So the benefit of that is it provides the company with a lot more certainty because they know exactly what they have to pay on an annual basis. It won't be fluctuating when the prime lending rate fluctuates. Alright, so those are all of the headings that you need to discuss. And then after that, please remember you must always conclude. And the conclusion should be based on your discussion. So if you concluded they should go for the bank loan, that's fine as long as it makes sense with your discussion points. I would conclude in this scenario that it's safer for them to rather issue the non-redeemable preference shares. In light of the tough economic environment that they are dealing with, the fact that the print media industry is declining, the fact that they haven't yet actually developed the online platform and they don't know how successful it's going to be, all of those things create a very high risk environment for the company. So it's better for them to keep financial risk as low as possible and rather go for the preference shares. And my logic behind that is also because the difference in cost is not that significant. The loan had a cost of 7.1% and the preference shares had a cost of 8%. So obviously the loan is a lot more cost effective. However, given the risks that I just discussed with you, I think it would be a lot safer for the company to rather go for the preference shares.